that classic early maturity issues of an industry. Um, the 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 unintended consequence of fast-paced scaling of growth of fintechs is that you are also going to have early maturity problem, and that's what we are seeing in many sectors in which there's what I would call a classic competitive shakeout very early, in which the industries, the sectors or segments are being narrowed to 2 or 3 players. If you don't have scale, if you are not number 1 or number 2, you are not likely to even find any path to profit in the industry. The third guy is going to lose a lot of money, and the whole lot of guys who are 3, 4, 5 are burning capital. So that is what we will see. So I will say that we will see a lot of that early maturity tendency. It's going to be more intense over the next coming years, as you have mentioned, with Flutterwave and Paystack going for new businesses and diversify. That thing about when you have early maturity tendencies, and there's pressure on even your traditional margins because of consolidation. The natural reaction is, where is the next growth? Where is the adjacent segment or sector in which I can find new inflections of growth for my business? So that's what we see. We will see a whole lot of that in the industry over the next coming years. But I think one of the important lessons that we are beginning to see, and our fintech colleagues must pay attention to, is what makes us successful in our core business, and where the new inflections of growth we are looking for in adjacent segments. Are we going to uncontested markets that we unlock with technology, which is what we learn to do, where we are committed? Or if we must go into contested markets where there are early movers, 1 or 2, are we going with a generic proposition, or are we going with a differentiated play? We have seen 1 or 2 fintechs who try to do some adjacent play, and they seem not to have succeeded because all that they seem to have done is to offer exactly what the early movers are doing. And lacking scale in those segments, and lacking any differentiation, they seem to have destroyed capital. That's the question. That as we see this tendency, that's the question that I think our fintech colleagues will have to ask. If I'm going to play in the adjacent space, diversify my revenue, do I have a differentiated play? Am I going to an uncontested market? Those are the 2 conditions for success. The other thing I think we are likely to see is we may see what I would call the erosion of pre-consolidation regulatory arbitrage in many of these spaces. One of the reasons, and we must be humble, I've been on both sides, back here and front. One of the reasons why our fintechs, apart from our technology, we have done a lot of stuff, good work. But we must also recognize that we have been regulated in fintech compared to that. And we have enjoyed at the early start a lot of regulatory arbitrage, working in between regulations and so on. Consolidation means bigger scale, being systemically important. It means that regulator will pay more attention. There are now 2 or 3 players, rather than 5 or 15 fintechs in a segment. Regulatory scrutiny will be more intense, and therefore, previous regulatory arbitrage that might have been an advantage that some of us might have enjoyed might be eroded. Therefore, we may need to think about be more proactive in putting moats around our businesses in this new consolidation phase. I think those are some of the 2 things I think we have to be very conscious of. You cannot, on the long run, build competitive advantage of a business on weak compliance. It's very good compliance cannot be a competitive advantage on the long term. Those are some of the lessons of this new consolidation phase, I think, that our fintech colleagues would have to be more conscious of in addressing.
And those are very valuable points.